Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions, generally related to three different topics: wealth building, commodities, and/or financial topics. So let's dive in there. Let's take a look, see what people are sharing, and I'll share my opinions as we go through it. If you want to follow me, it's @Finance. If you want to join our community, finding-value.com, where I dive deeper into all of these topics. I did release a midweek update today, so look for it, given and sharing my opinions on the market and what I am doing personally in the markets. So coming on down, we've got Trend Spider number go down for Ethereum. And what he's posting here is a lower high and a potential inverted flag pattern that is broken to the downside. I'd like to see follow through on this before saying that this is for surely going lower, but it sure looks like to me that this is going to head lower. And one of the things that you look for is you can see this resistance line going across in the shaded area. A lot of the times what it does is it breaks out to the downside. You come back and do a retest of the shaded support resistance level, and then it breaks back down. So that does look pretty weak for Ethereum. This also aligns pretty well with an inverted yield curve and unemployment going up and a potential um, NASDAQ bubble is what we'll call it, a technology bubble. All of the things and signs and leading indicators are there for technology stocks. Also, their valuations being completely overpriced and overvalued. All the signs are there for this to go lower in not just Ethereum, but in the technology stocks. We also have seen insiders with massive selling. NVIDIA's CEO, Zuckerberg, we've got Amazon's CEO, Bezos. They're all selling. Bill Gates, they got out of the market. So this is all kind of in alignment with potential lower pricing and all this stuff. Now on the opposite side, so this is what is weak in the market. Now, what goes strong during the same market conditions is gold. Gold is on the verge of a breakout to an all-time high, and notice this pattern that it's being created. I've seen this pattern break over and over. It's the same pattern that we have here going on, and then we get a nice big surge higher. This year, the whole thing is called the stair-stepping pattern. This is where I would be looking if I were you guys. And if you are interested in knowing the companies that I'm playing this with, I am sharing that in the midweek update, those companies. And you'll probably see me buy some of those companies pretty soon. I'm already in them in the main portfolios, but you'll see me continue to add to them over time. Here's BHP Group. So I know I talked yesterday about Codelco and their struggles to increase copper production. Well, here's BHP Group. It plans to double its South Australian copper production to over 650,000 metric tons annually by mid-2030s, driven by growth at Olympic Dam and the Oak Dam discovery. The first phase of expansion will increase capacity to 500,000 tons annually, with a final decision expected in fiscal 2027. So there are some areas and projects coming online to increase copper production, and that I think will probably be pretty profitable for BHP Group during that time frame. I think in the late 2020s is where a lot of these pricing for commodities are going to go ballistic. It could start now. It could start after a slowdown. We don't know, or I don't know the path that this is going to take in the short term, but definitely after this slowdown occurs, whether it's now or a year from now, I think pricing is going to go way up for a variety of different commodities. So think of it as the end of wave two for the commodity sector. Parker Ross says the conference board's measure of consumer confidence beat expectations in August, 103.3 versus 100, and was up from an upward revised 101.9 in July. However, consumers continue to take an increasingly sour view of the labor market as reflected by the labor market differential, or net share of consumers saying jobs are plentiful, less those saying jobs are hard to get. This is my favorite indicator from the report given how well it has historically tracked the changes in the unemployment rate. The labor market differential declined further to 16.4% in August from 17.1% in July, and the recent peak 47% in July of or early of 2022. So when looking at this chart here, we can see that there's recessions on here. Oops, let me go over here and so you guys can see it. There we go. The recessions are the dark shaded areas. Every time we see the unemployment rate go up and the differential, we get these recessions almost every time. So we've been going up here, and it's like we've probably already have entered a recession. Remember in 22-23, where they basically changed the definition of a recession? I think we're in it, and we're going through it right now. And that's probably why they probably didn't want to lower rates at that time. They probably wanted to keep the dollar stronger for longer, is my guess. So they are cheating the data to look like it's better and stronger than what it really is. So there's probably a bunch of manipulation going on with the numbers, but it's really hard to manipulate the unemployment rate here. So we're probably already in a recession or have gone through it or are going through it. And this is just that data showing that. If we had this type of move in previous times, they would have said it was a recession, as you see in all these other instances. Casper says for crude oil, the pinch in momentum band on the weekly time frame has always led to a huge drop in oil. The previous two times where we were below the golden 2008 trend line, now above, will this time be different? I think we will get a drop, and I think we'll use the golden trend line as support, and I think that will be the buying opportunity. That would be my guess. But here's the trend lines converging and then the drops of each of those. This was the 2020 COVID crash, and this one here was overproduction. I don't think we have overproduction. So whatever drop we do get, as long as they don't completely shut down the economy, I don't think it will be as big as these two previous drops, but we could still get a healthy correction. It's still possible. I'm still open for that possibility. Here's Koyfin, and this is Stanley Druckenmiller on waiting for the fat pitch. He says, I'm waiting for the fat pitch and constantly reevaluating my process. The good thing about playing big is you don't get lazy. I just want to stay alive financially until the chaos comes, because it's coming. I don't see the fat pitches currently. I'm not as good as an investor as I was in my 30s and 40s years ago. I can predict better. I don't pull the trigger the way when I was young. I only hire people in their 20s. Once you have the scars I have, it wears on you. You have to have humility. If someone ever asked me what made me so successful, my first answer would be having an open mind. I had positions where I was sure I would hold them for 2 years, and a week later, I was short because conditions changed. And if conditions change, you have to move immediately. That's from Stanley Druckenmiller and what his opinions are there. And right now, he doesn't see the fat pitches currently, in his opinion. Agree with there. Jesse Felder says outflows from energy ETFs this year have been relentless. Investors have sold 1.2 billion from the funds so far in August, taking year-to-date outflows to $8 billion. If you look at equity energy, you can see the big red amounts here. Year-to-date, 8888 right there. So there are outflows of energy, and I'm sure that has to deal with the market conditions. Pretty sure of it. Josh Young, and this is the fundamentals. So this was the financial macro view going on above in energy. And here, this is the fundamentals of the sector itself. It says another good chart, substantial exploration and delineation efforts are needed to sustain current levels of oil consumption. If oil demand grows on trend at 1% per year going forward, even more will be needed. Long term, it's very bullish for oil. So, long term, just like uranium, we've got these big gaps coming. In oil, this is global oil supply with no investment, and this is the decline rate that you see going out to 2050. Pretty rapid decline rate. This is investment in existing fields, and that slows the decline rate down, which would be new wells in existing fields. But this is new resources and projects needed that aren't in the existing infrastructure, which is tremendous. So, what's going to happen when we get to the mid 2020s here, which is where we're at? What's going to happen going forward here? Are we going to have supply problems where the oil price goes way up? That is my guess. Or are the macro conditions going to be so bad that we get a decline in oil price first? That is the question. It's going to be supply versus demand and how much supply gets destroyed from basically no investment going into it or little investment. I should say underinvestment. Or is the macro picture going to override it? And I'll tell you what, guys, this is a difficult call here. I think that we'll probably get a pullback from the financial side of it, and then we'll see what the physical side has to say about the price being that low, because you're going to kill supply if the price of oil goes any lower than where we are at today. This is the VIX, and this does scare me a little bit. And what he does is he put a fractal overlay of the VIX in 2008 and then the VIX year to date. And look at that. Do we have some sort of event coming where the volatility spikes back up again? Which would be, if we're at a day 140, and this would be at day 172, that means in about 32 days that this volatility could spike again in 1 month. So sometime in September, we could see a volatility spike. And when the volatility spikes, that's generally when you get your big declines. So is there a big decline coming soon in like 30, 40 days? We'll find out. Here's oil. Now, this is looking at it from a bullish perspective. He says latest biweekly candle that closed also made it back into the bull. So if we couple those two recovered candles and the latest into one, and they hold to the close, we'll have a monthly hammer back inside of the bull. So that would be a bullish formation. Here's the hammer candlesticks bouncing off support, where we could potentially head higher. But we are still squeezing between the two support levels, and we haven't broken in either direction. We've got a lot of macro fundamentals, macro financial driven bearishness, coupled with supply side bullishness. And right now, they are teeing up against each other. So we'll see which direction we break here over the next month or two. We've also got this VIX over our head here. I don't like seeing that. So this is more fundamental on oil. It says global oil inventories are at their lowest seasonal levels in recorded history. This is in spite of absorbing 216 million net barrels from the U.S. Strategic Political Reserve and weak Chinese demand. This is not bearish. Yeah, so the physical side and the inventories are all very bullish. And that is teeing off against a macro environment, which is a potential slowdown across everything. Now, if we are in a recession already, if we are on the slow side, we are still eating through inventory in terms of oil. So if you are bearish, you are betting that things are going to get much worse and that this inventory will eventually work its way on up. If we continue on the path that we've been on, where we have perhaps stagflation, where it's a slowdown with a lot of inflation, we could still see inventories drop, even given a slowdown. So the environment here is a really difficult call on which direction oil is going to go in absolute nominal terms. Just say in nominal terms, not absolute terms, in nominal terms. A tough call there. Here's a quote. The stock market is filled with individuals who know the price of everything but the value of nothing. I still think that's the case. Here's another one. We continue to apply a simple three-step investment strategy. Buy good companies, don't overpay, do nothing. Terry Smith. That's basically what I try to do. Steve Hankey, I just thought this was funny. He says research finds crypto owners are psychopaths. University of Toronto researchers found that crypto holders display lower levels of analytic and scientific thinking and are likelier to exhibit psychopathy than the general population. I don't know if I agree with that, but I just thought that was funny that he's sharing this information. And I don't think that's necessarily the case, but that's what his opinion is. Here's Brett. So in 2007, the Fed funds rates were 5.25% at the timing of the first rate cut. Between September 18th, 2007 and April 30th, 2008, the Fed cut rates 7 times, taking the rate down to 2%. In 2024, the Fed rates are 5.25 to 5.5%. Rate cuts should begin on September 18th, the same date. Current probabilities show 9 potential rate cuts, lasting through September 17th, 2025, taking the rate down to 3.25 to 3.5%. These are the current probabilities using the CME Group FedWatch. So 2008, here's the decline in the rate cuts, and then the potential bottom here in 2009. And here we've got the projected rate cuts, and these are the 7 cuts here, and these are the projected rate cuts that are coming to go lower. So it's a similar situation to 2008 and where we are positioned today. It says, are we in the matrix? 2007, July. So here's July 17th top, a full recovery for a double top potentially. And then we've got the decline of the rate cuts. First rate right here, and we went a little bit higher for that first rate cut right after, and then the sell-off occurred. So that selling pressure sell-off could occur towards the end of September. And you know what's really weird? The end of September correlates with this VIX. This is towards the end of September because if we're 30 something days away, that puts it at the end of September, beginning of October, for the VIX to go up and start to ramp up here. That also correlates with previous fractals of a potential turning lower. So these things all align quite well, which makes this very scary. Here's Grady. So silver is yet again holding orange 28.5, $28.50 support, telling us clearly that this is a very important level. And note that after previous yellow dash marked breakouts, it just kept moving. This is very good looking big picture chart in terms of a potential breakout here at any second. And I agree with that. Silver's going to rip. Here's another one for GDXJ. This is what has now started. The chart looks ready, the market opportunity of a lifetime. So GDXJ, gold miners, monthly candles, a massive rounded bottom, arc cup in the making, ready to climb the right side. Obviously, he says we bought heavily here at the service, just right here. But I agree. I think this looks really good for a big move higher. And then most bearish positions ever in Canadian dollars. Happy to take a contrarian view on this one. So Canadian dollar positioning down here at most bearish in history. And maybe it stays down there for a little bit longer if we get that volatility in the market, the big pullback that is potentially coming in 30, 40 days. But that could impact this still in a negative way, and it could stay low here. And maybe that's why people are in the most bearish, because people know kind of what's coming maybe. It says the highest form of wealth is the ability to wake up every morning and say, I can do whatever I want today, says Morgan Housel. I like that. And here is even the invincible NASDAQ could not surpass its dot-com feverish highs priced in silver. Now observe the crumbling rate of change. This is the loss of momentum required and the gateway set up for a true breakdown for NASDAQ versus silver. And all the conditions are aligned for this to occur, guys. It's all right there. So the mighty NASDAQ priced in silver, we're right above the support level that's about to break to the downside. And what this is telling us is the market conditions. The market conditions that are coming is going to be a capital rotation. Totally agree. And we're going to see, the peak rate of change of the NASDAQ. The peak rate of change was 2021. We're coming on down, and this is the bull era for silver that we're about to enter. This is where all the opportunities are at. If you know the market conditions and what causes these assets to change against each other. So it's coming. Gold and silver are going to outperform here. And this is the great marquee S&P 500 double top. We've got a low volume rise. God, this just screams that we are topping here. It's a telltale sign. Deep valley below the double top meets criteria. Beware of large red candles as they signal confirmation of the reversal. So we await a potential move lower here at any second. The S&P 500. And here's copper discoveries, 1900 to 2023. Look at how little we've gotten in copper discoveries. It's just decline to nothing. I'm sure that we're going to have all these big, huge projects coming online with all these discoveries that we've got, which is nothing. You love to see it, GDX. So the past 6-month ETF flows in millions. You can see GDX is coming out, while BTC, QQQ, and SMH, this is not good, guys. This looks like a top. So this looks like a bottom down here for these. SMCI versus Qualcomm in 1999. It's incredible how these bubble charts all tend to look the same. So this is your lead in here, and then your blow off top, your bear trap, which has already occurred in SMCI, and then the move lower all the way down. And this is your valley of despair is all the way over here. And that's all we've got for today, guys. So give me a thumb up for the content. Subscribe to the channel, subscribe to the website, and we'll catch you guys later. This is Finding Value.